My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Headache time again. Though it is really getting less each week. I must apologise once more for the multitude of lines and labels that I've drawn and have kept on this daily chart. However, technically there's still much going on here. And these labels and lines are all valid in my deciphering and trying to decipher what is happening on here. Okay, so instead of usually giving a big history, I'll instead talk about the action from the peak of May and reference earlier pieces as I deem necessary. Market's peak in May was at the neckline of the August to November 2021 complex triple top, currently at 2061, breaching it ever so slightly before the rally failed and we saw prices drop, gapping lower. The mess of congestion support we'd seen around the middle time at the time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1936, mainly was the combination of the February 2021 high at 1894, the medium moving average currently 1939, long moving average currently 1906, and the short medium moving average currently 1892. They eroded the bearishness on the way down from the start of May until the middle of the month, such that though prices pushed further down below all of them, the market did not have the immediate energy to aggressively push too much lower. For instance, we did have support below this congestion from another congestion area dating from February this year, between approximately 1840 and 18 even. 3 weeks ago, the market tested down and through this area all the way down to breach the lower time, currently 1771, of the more recent April to May bearish shift pitchfork. Yet the market did not break it, as a fall only extended down to the 50% Fibonacci line of the March to November 2021 move at 1768, before prices turned back up again. This 50% Fibonacci line has been very influential as it stopped earlier declines in January, February and March as well. Remember that number and that Fibonacci line. These two supports, the declining lower time and the 50% Fibonacci line, turned prices back up with such vehemence that by Monday last week prices were over all the moving averages as well as the middle time of December 2020 to April 2021 bullish shift pitchfork, and almost up to testing the upper time of the recent April to May bearish shift pitchfork. Thus, we have seen dramatic moves up over both bearish and bullish patterns that occupy the daily chart, but just in different time references. 3 weeks ago, the market made a weekly key reversal up, and last week prices came ever so close to setting up the conditions for a monthly key reversal up. Prices needed to exceed 1968 by Friday the 30th of July, and then close over 1940. Both these things were eminently doable when I last spoke and tied in with my final comments from 2 weeks ago, and I quote, "So at the same time the bigger picture is still a slowly rising bullish shift pitchfork, whilst the more recent move is a bounce up within a much smaller bearish shift pitchfork. Such a situation cannot last, one of these two will have to give way." End of quote. Well, something most definitely gave way, but in a somewhat unexpected fashion. The close over the middle time of December 2020 to April 21 bullish shift pitchfork last Monday was not followed through. It turned out to be the high water mark, as from Tuesday up to and including today, prices have dropped like a stone, creating a contrary, larger weekly key reversal down last week in a reaction to the weekly key reversal made only 3 weeks ago. This past week the market has motored down through all the moving averages, the middle and lower time of the bearish shift pitchfork, and most importantly of all, prices today have punched down through the key 50% Fibonacci line. Remember, I asked you to remember that number of the March to November 2021 move at 1768. This one is the crucial one. As you recall, I earlier said this 50% Fibonacci line held up declines from January, February, March, and most recently 3 weeks ago. Now, breaching this key 50% Fibonacci line is fine. What matters is multiple consecutive closes below it. And that is what this week is all about. because if that happens, then the important and as yet untested lower time of December 20 to April 21 bullish shift pitchfork, a bullish pitchfork which has been effective in showing the way higher, will be under threat. If that goes, then we are in a whole new world. As it is, this market looks set today to make the lowest, well, it has made the lowest low and lowest close since July last year. Ice Europe white sugar in London. Well, it's not like I didn't warn you that something might happen around here. I'd previously warned thus, and I quote, "Now, what I would like you to note are the two round circles on the daily chart. They indicate two dates when the tines of the bullish Andrews and shift pitchforks cross over. The first one is partially obscured, but it's also today, and that was 2 Mondays ago. The second is on Friday, the 22nd of July. Now, what to expect? Well, look for one or more of the following possible actions: volatility, a change in trend, and or a reinforcement of a trend. This usually happens when the tines cross over or soon thereafter, hence the circles and the caution. I suppose this goes some way to explaining the wide range we've seen today. Nevertheless gives notice of another potential volatile day only about 2 weeks hence." End of quote. And that was last Friday, that 2 weeks hence. So that's what was happening back in early July and also last Friday. I'll now deal with one glaring detail that is obviously on the daily chart, the changeover gap. Now I use continuous daily charts here, and that results in gaps on my daily chart. This one here happens to be one of the larger ones I've seen. Okay, rather than going into why I should or shouldn't use continuous charts, please accept that I do, and that we will therefore have occasional gaps. In this case, the market had gapped down below the lower time, currently 576.40 of the February to May bullish Andrews pitchfork. During the course of last week, dropped down through not only all the moving averages, including the long moving average, currently at 525.10, but also the lower time, currently 536.60 of the bullish shift pitchfork of the same move as the bullish Andrews pitchfork. Both pitchforks will be now retired after this commentary. In addition to all that, the market had punched down through the neckline, currently 535.90 of the August to December complex head and shoulders top. Prices today have started to run into layered congestion. Quite spread out, but still there, at 509.40, 514.5 and 517.80, as well as the congestion evident from the September 2021 to February 22 diamond continuation pattern, the edge of which you can see in the bottom left hand corner. But the most significant piece of support is the 50% Fibonacci line of the July 21 to July 22 move at 506.30, which today the market approached, breached, but then recoiled from it. This may be the most significant level of all. Just one other quick point, and it is a controversial one. If we close this coming Friday below 556.60, which, let's be honest, looks very likely, then we will have a monthly key reversal down. The controversial bit is it will be achieved only on continuous charts and only because of the gap down in the middle of the month. Sugar white premium spread. The huge weekly bullish engulfing pattern 2 weeks ago, with the highest high and high close since 2011, has seemingly been neutered by a big gapping move lower, most notably below the middle time, currently 142.25, and a neckline of, to be fair, an imperfect looking June 2020 to date big reverse head and shoulders pattern. It was only a combination of the lesser Fibonacci lines at 124.25 and 122.5, as well as the rising medium moving average, currently 123.5, that managed to hold the market up, along with some roundophobia at the 120 even level. However, the main bullish incentive and the only pattern that is still operational, the only pattern that's still left standing, is the 2019 to 2021 bullish Andrews pitchfork, and this is still good. This is quite a feat, but it's not worthy of boasting about, as it has suffered some significant jarring events. This also puts at extreme risk target X1 in the 191.5 area. This is a secondary and harder to reach target for the recent bullish ascending wedge pattern. Looking ahead, I think it best to refer to two commentaries, one from a few weeks ago covering target X1, and I quote, "I know that these are humongously big asks, but that is what I see. It depends on one thing and one thing only, that prices maintain contact with the middle sign or break upwards clear of it." End of quote. My second commentary, I refer to what I said last week, and I quote, "Well, so far prices have tried breaking higher but have failed as yet to reach target X1. However, the market, though gapping lower, has not as yet completely lost touch with the middle sign. Only if that happens, then it would be appropriate to maybe, and I say maybe, retire the harder to reach topside target at X1. End of quote. We are now so very close to retiring target X1. One final point, and is this: much as London Sugar, a controversial one, we're on the edge of making a very large monthly key reversal down and monthly bearish engulfing pattern in July. But it will be made with the aid of gapping move lower due to changeover, something I'm not entirely comfortable about, but it's still there. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. Here comes the final bit.